Accounting Adjustments Problem 2. Big Apple Company sells tickets in advance for its weekly productions. On March 1st, the Unearned Revenue account had a credit balance of $4,000. During March, Big Apple sold 500 tickets at $40 each, and 450 tickets were used during the month. What is the balance in unearned revenue at the end of the period? When looking at the four major types of adjustments, this is an example of unearned revenues. The other types include prepaid expenses, accrued revenues, and accrued expenses. This is unearned revenues. The idea here is you've got a Big Apple company, play production company, and they do weekly productions. They sell tickets in advance. So they're selling these tickets in advance to weekly productions. On March 1st, the unearned revenue account had a credit balance of $4,000. Now, unearned revenue, that account is a liability. Now, always use our friendly acronym DEALOR, D-E-A-L-O-R. Remember, draw a line in the middle. The idea here is that these types of accounts, they increase on the left side, the DEA, the LOR increase on the right. That's the debit on the left, credit on the right. So debit left, credit right. D for drawing, E for expense, A for asset, L for liabilities, O for owner's equity, and R for revenue. So here we're dealing with unearned revenue, which is a liability, and it has a credit balance of $4,000, which means it has a positive balance because DEALOR shows what side they increase on, which means it's a positive and increased balance. So we have a $4,000 positive balance in unearned revenue. During March, Big Apple sold 500 tickets at $40 each, and 450 tickets were used during the month. 450 tickets were used during the month. Before we do the calculation and we're trying to determine the ending balance, just understand what's going on here. Big Apple Company, again, play production. They sell tickets in advance for their weekly productions. So think about your favorite sport. Maybe you like baseball, basketball, football. Think about season tickets. They sell the season tickets early. The idea is that the customers are going to pay money before the games are actually performed. Here, the plays are actually performed. So when the sale takes place, they're going to collect the amount. They're going to collect the amount. Big Apple's going to collect cash or whatever it is, credit, whatever is going on. They're going to collect the amount of cash from the customers, and then they're going to credit a liability because now they've collected money, but now they have a legal right to perform services in the future. They have to perform those services. Now, that's not the adjustment. The adjusting process is as the play productions go on or as the games are performed, if you're looking at the sports teams, then you can write off or you can take a liability and reduce it. Now, every time a game is performed or every time a show performed, are we going to make a journal entry? No, that makes life challenging. It makes things inefficient. The idea here is that we do so at the end of the accounting cycle, and that's why this is called an adjustment. Adjusting entries, we adjust these things for timing. The unearned revenue, which is the liability, turns into being performed, and there we can write it off. We can write off that liability, and we can record the actual revenue when it actually occurs. So an unearned revenue, in the future, it turns into a earned revenue. And the idea is that when the unearned revenue is initially recorded, cash is collected. But again, there's this right that has to be performed, a liability. And then when that liability takes place, then we can write it off and we can record it as an earned revenue. We can switch it from unearned to earned. And again, we don't do this after every performance. We do this at the end of the accounting cycle. So the acronym to help you understand how to calculate this is BASE, B-A-S-E, one of my favorite acronyms. And BASE can be used for many things, but BASE, the B is for beginning balance, the E is for ending balance, and the idea is that the A is for add and the S is for subtract. Now the beginning balance, we're told here, we had a positive credit balance at the beginning of the period, right? We're looking at March, the period of March. So let's say that this company, they do their adjustments each month. So in their calendar year. So in March, they're going to do this calculation at the end of March. They're going to do this adjustment process on March 31st. The beginning balance is a positive $4,000. So it's positive. That's why the credit balance is so important, because we looked at DEALOR, we have a positive balance. We're going to add and subtract a few things. We're going to add again, we're looking at the unearned revenue account. We're going to add the increase in the tickets that we sold in advance. So we add the increase in tickets sold in advance during the period, which here we're told in the problem that during March, Big Apple sold 500 tickets at $40 each. So 500 tickets at $40 each, which equals $20,000. So we're going to put increase 20,000. Now the subtract is going to be the tickets performed during this period of time, during this month. So during the time period, so we'll say during the month, which here we're told they performed 450 tickets were used. So this could be tickets that were sold even before March 1st, back in January, February, even from the previous year, sold in advance. And the idea is that these now have been performed. So they're no longer, they shouldn't be on the books as a liability. So 450 at $40, this equals 18,000. So that's going to be, we subtract that 18,000 and we do this calculation, our ending balance is going to be $6,000. Now this is a positive 6,000. Remember, dealor, this is the liability. Unearned revenue is a liability. So if it's a liability, liabilities increase on the credit side, right? L for liability. Liabilities increase on the credit side. So this is a $6,000 credit balance. Now, one thing to note before you finish this problem, if I gave you any of these numbers, if I gave you the 4,000, the 20,000, the 18,000, 6,000, you could use this base formula and you could calculate the other items. Go ahead and try that. Go ahead and try assuming that you're missing one of these aspects and you could calculate that.